Have you ever wondered what exactly happened during the 2008 financial crisis? It's a story that involves houses, complex finance, and a chain reaction that shook the entire world. But don't worry, it's not as complicated as it sounds. Let's break it down together, step by step. It all started with something pretty simple. The American dream of owning a home. In the early 2000s, interest rates were really low, making it cheaper than ever to borrow money. Banks and lenders were eager to give out mortgages, even to people who might have struggled to pay them back. These were called subprime mortgages. Think of it like this. Lenders were so confident in the housing market that they were willing to take on more risk. Why? Because for years, house prices had only gone up. It seemed like a sure bet. If someone couldn't pay their mortgage, the bank could just sell the house for a profit. What could possibly go wrong? Well, here's where things get a little more complex. Wall Street saw an opportunity. Investment banks started buying up thousands of these individual mortgages, the good ones, and the risky subprime ones, bundling them together into something called a mortgage-backed security, or MBS. An MBS is basically a financial product, a bit like a bond, that you can buy and sell. The idea was that by mixing lots of different mortgages together, the risk would be spread out. Even if a few people defaulted, the majority would keep paying, so investors would still get a return. These MBS products were then sold to investors all over the world, pension funds, insurance companies, even other countries, to make them seem even safer. Rating agencies, the companies whose job it is to assess financial risk, many of these bundles a top-tier AAA rating. This was like a gold stamp of approval, telling everyone, hey, this is a super safe investment. So, money from all corners of the globe poured into the US housing market. But Wall Street didn't stop there. They created even more complicated products called collateralized debt obligations, or C. Imagine taking the riskiest parts of those mortgage bundles, and then bundling them asterisk together into a new product. That's essentially what a CDO was. They were slicing and dicing the risk, creating layers of investments from the supposedly safest to the risk. The riskiest layers offered the highest potential returns, and in a booming market, they were incredibly popular. This created a massive, interconnected web of financial bets, all resting on one single assumption, that house prices would keep rising forever. And for a while, they did. The housing market was a massive bubble. Low interest rates and easy credit meant more people were buying homes, which drove prices up. Higher prices made lenders even more confident, so they gave out even more loans. It was a cycle that seemed unstoppable, but like all bubbles, it was destined to pop. The turning point came around 2006. Many of the subprime mortgages had adjustable interest rates. This meant that after a few years, the low introductory rate would jump up, and homeowners' monthly payments would suddenly get much more expensive. At the same time, the Federal Reserve started raising interest rates to combat inflation. Suddenly, millions of homeowners found they could no longer afford their monthly payments. This is where the first domino fell. People started defaulting on their mortgages in huge numbers. As more and more people defaulted, banks foreclosed on their homes. All these foreclosed houses went up for sale, flooding the market. Basic economics kicked in. When supply goes up and demand goes down, prices fall. And they didn't just fall, they plummeted. The housing bubble had burst. Now, remember all those investors who bought mortgage-backed securities and CD? Their investments were supposed to be safe because they were backed by the value of the houses. But with house prices crashing, the value of those securities evaporated. The safe AAA investments turned out to be nearly worthless. Panic set in. No one knew which banks were holding these toxic assets. The trust that holds the financial system together disappeared overnight. Banks stopped lending to each other because they were afraid the other bank might go bankrupt the next day. This freezing of credit is what's known as a credit crunch. Imagine the financial system is like the circulatory system of the economy. Credit is the blood that keeps everything flowing. It allows businesses to pay their employees, buy materials, and invest in growth. It allows individuals to get loans for cars or education. When that flow of credit stops, the entire economy grinds to a halt. The crisis reached its peak in September 2008. Lehman Brothers, a massive 158-year-old investment bank that was heavily invested in these toxic assets, declared bankruptcy. This was a seismic shock. It was like watching a skyscraper collapse in the middle of a city. The message was clear. No one was safe. Fear gripped the global markets. The stock market crashed, wiping out trillions of dollars in wealth. People saw their retirement savings and investments vanish in a matter of days. The crisis quickly spread beyond the United States. Banks in Europe and Asia had also bought these American mortgage-backed securities, so they suffered massive losses too. Global trade froze up as credit became impossible to get. It became a full-blown global financial crisis, the worst since the Great Depression. Faced with a total collapse of the financial system, governments and central banks around the world had to act. In the US, the government passed the Troubled Asset Relief Program, or TARP. This was a massive bailout package designed to inject money into the struggling banks to keep them from failing and to get credit flowing again. The Federal Reserve also slashed interest rates to near zero and started a program called quantitative easing, which is essentially printing money to buy up financial assets and pump liquidity into the system. These were controversial, unprecedented actions, but they were seen as necessary to prevent a complete economic catastrophe. The fallout was immense. The crisis led to a deep global recession. Millions of people lost their jobs, their homes, and their savings. The recovery was slow and painful, and the effects are still felt today. The crisis exposed major flaws in the financial system and a lack of regulation. In response, new laws like the Dodd-Frank Act were passed in the US to increase oversight, make banks hold more capital, and try to prevent a similar crisis from ever happening again. So, to recap, it started with a housing boom fueled by risky subprime loans. Wall Street packaged these loans into complex, supposedly safe investments and sold them worldwide. When the housing bubble burst, these investments became worthless, causing panic and freezing the global credit system. This led to the collapse of major financial institutions and triggered a severe global recession. It's a powerful reminder of how interconnected our global economy is and how quickly things can unravel when risk is misjudged and greed takes over. Thank you so much for watching. I hope this breakdown helped you understand the 2008 financial crisis a bit better. If you found this video helpful, please hit that like button and subscribe for more explanations of complex topics. Let me know in the comments what you'd like me to cover next. See you in the next video.